Guys, I'm going to run through this quickly because this is just basically revision of the work that you've done last week. This is all about the accounting cycle and the accounting equation. Now, just to give you some further guidelines, what is expected from you after the completion of this study unit, you should be able to understand the accounting cycle, you should be able to apply the accounting equation and the double entry principle, and you should be able to record all transactions in the accounting equation format as well as in the T account format. Now, there are two important videos that I want you to watch. The first one is all about the accounting equation, and the second one is a very good, it's not long videos, and it's very nicely presented. The second one is the one about the whole accounting cycle. What is happening in the accounting cycle? From where a source document is issued for a certain transaction that has been entered into until that specific transaction ends up in one or other financial statement. Just to recap, what are the steps in the accounting cycle? Number one, there must be a transaction. That transaction will be underlined or it will be manifested in some kind of source document. Now, that source document will be issued depending on the type of transaction that I've entered into. And that source document, the type of the source document issued, that will then tell us in what journal I have to record that specific transaction. You know that we have subsidiary journals, and the first time that we're going to record a transaction from a source document will be in either one of those subsidiary journals. Now, what is the purpose of the subsidiary journal? That is an analysis and a summary of all transactions that took place in a certain accounting period. Usually it will be for a month of the financial year. At the end of that period, I'm going to get a total, and what am I going to post to my general ledger? Only the totals that were accumulated of all the transactions that were done for that specific month, and only the totals are posted to the general ledger. Why? Guys, that will prevent our general ledger to become 50,000 pages thick. So it's just a summary. Should I wish to have further information about the transaction, I will go back and do a drill down to whatever subsidiary journal that transaction came from. And once I identify that transaction in the subsidiary journal, I can do a further drill down until I can work back to the source document, and that will be an indication of the type of transaction that was entered into. Now, here I want to stress that it doesn't matter whether I'm using a manual system. Nobody uses manual systems anymore. If you think about your computerized accounting systems like Pastel or Xero or whatever, QuickBooks, whatever you're going to use for posting your accounting entries into, what do? I have a transaction. What do I have to issue, or what should be issued with every transaction? Still a source document. What do I do with a source document? I enter it into my accounting package, but before I can enter it, I have to identify the type of source document so that I know where to post that transaction in my accounting package. So if it was, for instance, a credit sales transaction, then our source document would have been a duplicate credit invoice, and that credit invoice will then find its way to my debtors journal. So I know if I want to capture that document, I have to capture it into the debtors journal. And from there on further, the accounting package will do with that transaction what it's supposed to do. So it will accumulate all the credit sales for the month. At the end of the month, the posting to the general ledger is going to happen now automatically by the accounting package that you use. Good. Once it's been posted to the general ledger accounts are then balanced. So I'm going to find out what the final balance is. And then I'm going to prepare a pre-adjustment trial balance. Now I'm going to run through my trial balance. And I can identify now, let's say, certain items on my trial balance which represent prepayments. Let's say, for instance, we have prepaid our insurance for the year. So what is going to happen now? All the money is currently being recorded in the insurance expense account. we know that for year-end purposes, we can only account that portion of the expense that relates to the current financial period. So what are we going to do? We are going to pass an adjustment entry. What do? We take out that prepaid portion of the expense and we're going to transfer that to an asset account. Prepaid expenses with whatever the amount is. The same thing with income that we've received in advance. We are not entitled to recognize that as part of our income figure, so we have identified that item. Let's say it's interest or whatever the income was, and I'm going to defer that portion that I cannot recognize in my income statement in the current financial period to a further period. Now, in the video they talk about deferred income or deferred expenses. We like to use the words accrued income or income received in advance, accrued expenses or prepaid expenses. So we don't like to use the word deferred, rather use the word accrued. Good. Now, after we've posted all these adjustment entries, we can actually update all our accounts and then we can get a post-adjustment trial balance. That we're going to do, and we are going to need the post-adjustment trial balance in order to prepare our financial statements. Before we can do so, though, we are going to close off all our nominal accounts. Now, what is a nominal account? That is all our income and expense accounts. Why do we close it off? Because the difference between income and expenses equals profits, and to whom do the profits belong to? It belongs to the owners of this entity. So the net profit that's going to be calculated in the profit and loss account will then be transferred to an equity account. And then once I've done that, I can prepare the financial statements for the year. General type of transactions is credit and cash sales, credit and cash purchases, amounts received from debtors, amounts paid to creditors, amounts paid for purchases of assets, and then any purchases or sales returns. Now, we've done that already. I'm not going to go into this. We say source documents, though, must actually have certain minimum information included in it. All of them must have a serial number. Now, this one jumps forever. What is a serial number? That means that all source documents must be pre-numbered. Why? Guys, next year you have auditing, and then you should know that one of the crucial audits that you perform on any kind of transactions that happen in an entity is to follow through sequence numbers of source documents. Why? To identify whether all source documents that should have been recorded in the books of the entity has in actual fact been recorded. If there's a missing number somewhere, it means that there's a missing transaction somewhere. And you have to investigate why there's a missing number, what the missing number represents, and the reasoning behind it. Okay, then obviously the date of the transaction. A description of the transaction, and many times the name of the document will also be an indication of what type of transaction was entered into. Let's say that we have a source document and on the name of the document is a credit invoice. Let's assume that this credit invoice is an original credit invoice. Then it means that we have bought from somebody some merchandise, and that is why we sit with the original credit invoice. So the credit invoice is an indication that there was a credit purchase transaction. Obviously, the amount of the transaction, that must be recorded there, and then the parties who has entered into this transaction, that must also be there. So identification of the parties. Good. Source documents. Credit purchases, already you know that's the invoice that we received from the supplier, so we will have the original. Cash sales, now for that we can have either cash invoice or cash receipt or both. When a debtor comes and pays his account, we will probably issue to him a receipt, so we will have the duplicate of the receipt. When we sell an asset, there could be a receipt for the money that we've received for that asset. There could be a sales contract, there could be an invoice. Either one of those could be an indication that there was a sale of an asset. Bank deposit, there we have a bank deposit slip as well as our bank statements, and for all returns there are credit notes. Now, please note that if we as an entity return goods that we've purchased to the supplier, we may, it's not obligatory, but we may issue a debit note when we return the stuff to the supplier. The supplier then will issue a credit note to us for the goods that we have returned and which he has accepted back. Now, what is important is that that returns transaction is posted from the credit note issued by the supplier, and it's not being transacted or entered into the books from the debit note. So please make sure that you understand that quite clearly. Good, this is just a few examples of invoices. Please note the word tax invoice there on top. So we are going to do VAT just after this. And it says that according to the VAT Act, if you are a VAT vendor, so if you are registered for VAT, you have to issue tax invoices. And certain minimum information should appear on a tax invoice. Obviously, the name of the entity should appear, the date, a pre-number document should be issued, and the VAT number of the entity who has done the transaction, the JJ Products in this case, this VAT number must appear on the invoice. Otherwise, it's not a valid tax invoice. It's not to say it's not a valid invoice, but it's not a valid tax invoice and it cannot be used for VAT purposes. Then to whom did we sell? We sold to Rainbow Store, particulars of what we've sold, and then obviously the amount. This is a printed invoice. You've all seen this before, and that is also a printed invoice. And then this one obviously is our cash register, a role that we are quite familiar with. If you're going to buy something from a Spar, a Pick n Pay, Checkers or whatever, they present you with a cash slip. But in the background there, this cash register, all of them are computerized nowadays. In the background, it keeps a tally of all the transactions that went through that cash register. So at the end of the day, who's ever going to do the admin can just run a report from that computer for all the cash that was actually handled by that cash register and the type of cash. Was it for cash sales? Was it an amount that we received from a debtor? What was the nature of that transaction? Good. We say once we have a source document, that has to be recorded in one or other subsidiary journal or a book of first entry. Now, that involves that there will be analysis of transactions in terms of the double entry system. It will show you what accounts is going to be affected by this specific entry that you've passed. And then once a month, after all the similar transactions was recorded in one specific journal, the totals of that journal will then be posted to the general ledger. Now, credit purchases. We know that that will happen in the purchases. Another word for if the purchases journal is the creditors journal. You can use either or, I don't mind. Cash purchases, that would be in our cash book payments journal, or in which will also then be our cash book payments journal. Credit sales, that will happen in our debtors journal. Another word for that is our sales journal. You can use either or. Cash sales will be in a cash receipts journal, and then any other transactions which you cannot post in either one of those four journals, that will go to our general journal. Now, examples of that is, for instance, depreciation. If I'm going to write off depreciation on an asset, I cannot post it in either one of those four because there's no cash flow. So, and it is an internally generated transaction, so therefore that will go to the general journal. If I'm going to levy interest on an outstanding debtors account, well, probably I'm going to do it in the general journal because I cannot do that. It's not a credit sale. It's not a cash sale. So therefore, I will use the general journal. So if a transaction cannot be recorded in either one of these four journals, it will be recorded in the general journal. So from all these individual journals, I will make my bookings to my general ledger at the end of the financial year. This is what the general journal looks like. This is what the cash book receipts journal looks like. You've seen it all. You've seen the cash book payments journal. You saw how it works. So I'm not going to go into it. You know what the general ledger account is all about. You know that we post to a general account. So I'm not going to go into that. Ledger accounts. Well, what is important is that you know that you should make a distinction between those accounts that will end up in the statement of financial position. Which accounts are that? That is all our equity accounts, our asset accounts, and our liability accounts. Now, all those balances is going to be transferred to the next financial year. So we don't close it off. It is a running balance. It is actually carried over into the next financial period. In our statement of comprehensive income, or another word for it, statement of profit or loss and other comprehensive income, there we're going to record all our income account balances and all our expense account balances. So whatever the balance is, it's going to be transferred to our statement of profit or loss, or profit or loss general ledger account. And that then means that none of those will have a balance left on any income account or expense account or profit or loss account, because whatever the net result is of the profit or loss account, that will be transferred to capital. So none of these accounts will have a balance that is being carried forward into the next financial period. Just a short example, ABC Traders buys inventory amounting to 10,000 Rand on credit. They use the perpetual inventory system. Remember, what does that mean? It means that all the inventory transactions are being recorded into the inventory account. So they say, show the journal entry, show the posting to the general ledger. So the first thing that we have to identify, what general ledger accounts are involved. The second thing is the amounts, and the third thing is in what direction should the transaction be posted. So direction means debit, credit. The account is going to be debited, is trading stock, and very important, you have to show the statement indication. Guys, I cannot stress this enough. If you're not going to show the statement indication and this thing has counted 1 mark, you will receive no marks because there was no statement indication. Debited trading stock, statement of financial position 10,000, creditors 10,000 Rand, statement of financial position. So if you're going to post it, I'm going to debit my trading stock account with 10,000 and I'm going to credit my creditors account with 10,000. Now, so we're going to carry on right through the year, and all the purchases will happen on the debit side of the account, of the stock account, the inventory account. You also can call it trading inventory, not trading stock. And whenever I'm going to, remember it's a perpetual system, so whenever I'm going to sell any of these items, I have to update my inventory account balance. Therefore, the cost price of goods sold has to be recorded on the credit side of this account. So I will credit my inventory account and I will debit an expense account, cost of sales. So at the end of the year, we are going to balance off this account. We have on the debit side 150,000 Rand worth of inventory available to sell. We've sold 90,000 Rand of that inventory. So what do we have left at year end? We have left at year end a total of 60,000 Rand. So we carry over the balance on top of the totals, and we carry down the balance at the bottom of the totals. So at the end of the year, let me just go back. At the end of the year, that 60,000 carried down balance will determine that the trading inventory account has a debit balance of 60,000, and we know that trading inventory is an asset for us, so it should have a debit balance. Okay, so it's all about the balancing of accounts. So we say that in accounting, the double entry principle, the dual principle, in other words, applies. So all debits must always equal all credits. Also, you know how the accounting equation looks like. We say, well, in an accounting equation, assets equals equity plus liabilities. Now, we said, well, part of equity equals our net profit for the year. So what is profit for the year? It's income, which has a credit balance, less expenses that has a debit balance. So that at the end of the day, it will be transferred the net result to my equity account. So into my accounting equation, we'll have equity equals assets less liabilities. So equity has a credit balance, assets got a debit balance, and liabilities is got a credit balance. If we want to expand equity a little bit, what do we say? Well, we say, well, equity equals capital that was contributed by the owner plus net profits, which equals income less expenses, less any drawings or withdrawals that took place by the owners. So if you really want to expand it further, you can say capital contributed by the owner plus income, less expenses, less drawings. That will bring you back to equity. And what is equity equal to? Assets less liabilities.